Imagine this. You make a small investment overseas, maybe help out a family member with a business, or perhaps there's a trust somewhere you barely know about. What if I told you that could trigger a seriously complex IRS form, Form 54711, most people have never even heard of?
And the kicker is, missing it isn't just a little mistake. The penalties, they can be absolutely staggering. We're talking tens of thousands of dollars, easily.
Exactly. But here's the flip side, and this is what we really want to dig into today. Hidden inside all that complexity, there are actually ways to, believe it or not, save on your taxes, or at least save yourself from massive headaches and really costly errors.
That's our mission for this deep dive. We're tackling Form 5471, the information return of U.S. persons with respect to certain foreign corporations.
Right.
We want to make this intimidating form make sense for you.
Yeah, we'll unpack who needs to file it, why it's got this reputation for being, a nightmare, and most importantly, we'll shine a light on those key exceptions and provisions that could mean real relief, maybe even lower your tax bill.
It's about turning compliance complexity into actionable insight, maybe even strategic advantage.
Okay, so let's start at square one. Form 547V1. What is it, fundamentally? What's the IRS actually trying to get at with this thing?
Well, at its core, it's not a form where you actually calculate and pay tax directly.
Yeah.
Think of it more like an information return, a detailed blueprint, really.
A blueprint, okay.
Yeah. Its main job is to give the IRS the data they need about foreign companies and how U.S. persons are involved. They want to see the global picture, who owns what, where money's moving, and how these foreign activities might affect your U.S. tax liability.
So it's less about paying on the form and more about giving the IRS the pieces they need to figure out your overall tax situation, making sure nothing's slipping through the cracks like unintended tax deferral.
Precisely. It's about transparency for them.
Okay, that makes sense from their perspective. Practically speaking then, when and where do you actually file this detailed blueprint?
You physically attach it to your main income tax return. So that could be your Form 1040 if you're an individual, or a partnership return, maybe an exempt organization return.
Got it. Part of your main filing package.
Right. And both the main return and the 5471 have to be filed by the same due date, including any extensions you've gotten. And here's a really critical point, something that catches a lot of people.
Uh-oh. What's that?
If you have interests in, say, 3 different foreign corporations that require reporting, you need to file 3 separate Form 5471s, each with all its own schedules.
Wow. 3 separate forms for 3 companies.
Exactly. 1 form per applicable foreign corporation. Now, if multiple filing categories apply to you for the same company, you don't duplicate the info. You just complete all the relevant parts on that single form. But yeah, the 1 form per corp rule, it can add up fast.
I can see how that workload could explode quickly. Okay, the part that gets everyone's attention, the consequences. You mentioned staggering penalties. What happens if you mess this up or just don't file?
Yeah, the consequences are, let's just say they're designed to get your attention. It's way more than a slap on the wrist. Failure to file required disclosures can lead to some hefty penalties.
Like what? Give us some examples.
Okay, take Form 8333. That's the one you file if you're taking a position that a tax treaty overrides or modifies U.S. tax law and reduces your tax. If you're supposed to file that and you don't, the penalty is $1,000 for an individual.
$1,000 just for not disclosing the treaty position?
Right. And if you're a C corporation,
Yeah.
that jumps to $10,000.
10,000. Okay, that's serious money.
It absolutely is. It shows how seriously the IRS takes these disclosures. So understanding the rules isn't just good practice. It's about avoiding some potentially painful financial hits.
No kidding. So with stakes that high, who exactly gets caught in this net? Who needs to be filing Form 5471? Let's get into those filer categories.
Okay, but first we need to quickly nail down a few key terms the IRS uses. They're pretty important for understanding who fits where.
Lay them on us.
First, U.S. person. This is broader than just individuals. It includes U.S. citizens, residents, sure, but also domestic partnerships, domestic corporations, and even certain estates and trusts.
Okay, so it's not just people, businesses too.
Right. Then there's U.S. shareholder. Specifically for Category 1 filers, this means a U.S. person owning, and this can be directly, indirectly, or constructively, which will get into 10% or more of vote or value of a Section 965 specified foreign corporation, or SFC.
SFC, Section 965. That sounds very specific. What's an SFC?
Good question. Section 965 SFC is basically either a controlled foreign corporation or CFC, another key term we need, or it's any foreign corporation that has at least one domestic corporation as a U.S. shareholder. It ties back to those complex repatriation tax rules from a few years ago.
Got it. And the other term you mentioned, CFC, controlled foreign corporation.
Yes, and this one is critical. A CFC is a foreign corporation where U.S. shareholders, remember, those 10% or more owners we just defined, collectively own more than 50% of the vote or value on any day of the year.
So it's about collective control by U.S. shareholders, not necessarily one single person owning over 50%.
Exactly. That 50% threshold is what triggers a lot of these rules.
Okay, definitions down. Let's walk through the 5 filer categories now. Category 1, who falls into that bucket?
Category 1 filers are those U.S. shareholders of a foreign corporation that was one of those Section 965 SFCs we just talked about. It's often about leftover reporting from that repatriation tax.
Okay.
Now, there are actually subcategories, 1A, 1B, and 1C, and the difference matters quite a bit, actually. Categories 1B and 1C get access to some specific relief provisions, ways to potentially simplify filing. They were originally just for Category 5 filers.
Ah, so right away, understanding your exact subcategory could potentially reduce your filing burden. That's a key insight.
It absolutely is. It's an early example of how knowing the details can save you time and effort. It's a potential tax saving, or at least compliance saving, opportunity.
Is there an end point for Category 1 filing? When does that obligation stop?
Thankfully, yes. Generally, you can stop reporting under Category 1 when the SFC doesn't have any more accumulated EMP that's earnings and profits related to Section 965 to report on Schedule J, or when the filer, you, don't have any more previously taxed EMP related to Section 965 to report on Schedule P.
So once that specific pool of Section 965 earnings is fully dealt with, you might be done with that category. Good to know. What about Category 2? What triggers that?
Category 2 is triggered by an acquisition.
Yeah.
Specifically, if you're a U.S. person and you acquire stock in a foreign corporation, and that acquisition pushes you to owning 10% or more of the vote or value.
Okay, hitting that 10% mark through a purchase.
Right. Or even if you already own some stock, if you acquire an additional 10% or more. So it's really focused on that specific event of acquiring stock. A single transaction can pull you in.
So one purchase, and suddenly you've got this potentially complex filing. Good to know. Category 3, how is that different?
Category 3 covers a few scenarios involving ownership changes. It includes U.S. persons who acquire stock that meets that 10% threshold, similar to Category 2. But it also includes someone who is already a shareholder and acquires more stock to meet the 10% requirement.
Okay, acquiring stock again.
And interestingly, it also covers situations where you dispose of stock enough to drop you below that 10% ownership threshold. So both buying and selling can trigger Category 3.
Buying and selling. That's interesting. Anything else special about Category 3?
Yes, there's an extra requirement. Category 3 filers have to attach a separate statement to their 5471. This statement needs to detail things like any debt the foreign corporation owes to related persons, and also list who subscribed to the shares and how many. It's about providing more transparency around these ownership shifts.
Gotcha. More detail needed there. Okay, Category 4. This one involves control. How does the IRS define control here?
Category 4 is for U.S. persons who had control of a foreign corporation during its accounting period. Control means owning, directly or indirectly, more than 50% of the total voting power or the total value of the stock.
More than 50% seems straightforward enough.
Well, here's where it gets potentially complex. This control can be indirect through layers of ownership. Imagine U.S. Core A owns 51% of Foreign Core B. B owns 51% of C. C owns 51% of D.
Okay, a chain.
Right. In the IRS's view, Corporation A controls Corporation D. Even though it doesn't own a single share directly, that ownership chain flows down, so you could have a filing obligation for a company you've barely heard of several tiers down.
Wow, that indirect control rule could definitely catch people by surprise. Okay, last one, Category 5. This sounds like it connects back to those CFCs, the controlled foreign corporations.
Exactly right. Category 5 filers are U.S. shareholders of CFCs. This is probably the most common category for many folks with international business interests.
Excellent.
And like Category 1, it has important subcategories, 5A, 5B, and 5C. Again, 5B and 5C are key because they implement specific relief provisions, ways to potentially reduce the filing burden based on IRS guidance. Understanding if you fit into 5B or 5C is, well, it's really important for streamlining compliance.
Another potential simplification built into the rules.
Good.
Is there any overlap, like if you qualify for both Category 4 control and Category 5 CFC shareholder?
Yes, and there's a helpful rule here. If you satisfy the conditions for both Category 4 and Category 5A for the same foreign corporation, you only need to check the box for Category 4 on the form. Just one box needed in that case.
Okay, a small simplification, but every bit helps, I imagine. Now, with all these categories, sometimes multiple U.S. people might have to report on the same foreign company. Is there any way they can, team up, file together?
Absolutely, and this is a huge potential efficiency saver. If multiple U.S. persons have to report for the same foreign corporation for the same period, they can file a joint Form 5471.
Really? How does
Yeah.
that work?
So, for example, a Category 5 filer could file jointly with a Category 4 filer. Or maybe two Category 5 filers involved with the same CFC could file together. For Category 3 filers, the rule is slightly tighter. You have to file jointly with someone who has an equal or greater interest in the company.
That sounds like a massive time and cost saver, turning multiple filings into one coordinated effort.
It really can be. It reduces duplication and the chance of inconsistencies. It's a significant compliance benefit that not everyone might be aware of.
Definitely worth knowing about. Okay, now for the section I think many listeners are waiting for the aha moment. When do you not have to file? This is where understanding the rules can directly save you time, money, and stress, right? By avoiding the filing altogether.
This is exactly where knowledge translates directly into savings. These exceptions mean you might avoid the whole process, preparing the form, gathering the data, filing it. Huge relief. And there's a really important theme running through several key exceptions, especially for categories 1, 3, 4, and 5.
Okay, what's the theme?
It revolves around constructive ownership.
Constructive ownership sounds a bit abstract. Can you give us a simple example of how that exception works?
Sure. Let's say you personally don't own any shares directly in a foreign company, but maybe your spouse owns 100%. Because of attribution rules, the IRS might say you constructively own what your spouse owns.
Okay, so ownership is attributed to you even if you don't hold the shares.
Right. Now, the exception kicks in if the reason you have a filing requirement is only because of this constructive ownership from another U.S. person, like your spouse. And this is critical, that other U.S. person is actually filing a Form 5471 that includes all the required information for that company.
So if my spouse is already filing and reporting everything, I might be off the hook.
Exactly. And here's the best part. If you qualify for this exception, you don't even need to attach a statement to your own tax return explaining why you're not filing Form 5471. The IRS already knows the info is coming from the other person.
That's fantastic. No extra paperwork, just relief. That seems like a major simplification. Are there other similar exceptions, maybe specifically for categories 1 and 5?
Yes, a few more really helpful ones. One applies if you don't own any direct or indirect interest, and your only filing requirement comes from constructive ownership attributed from a non-resident alien.
So if the ultimate owner is foreign and ownership is just attributed to you, you might not need to file.
Correct. Again, no statement needed. The IRS seems to view the U.S. connection as too remote in that case.
Okay, another good one. What else?
There's another one for Category 1 and 5 filers. It applies if, basically, no U.S. shareholder owns stock under a very specific definition, Section 958A stock on the last relevant day, and is a foreign-controlled SFC or CFC. It's a bit technical, but it provides relief when that direct U.S. ownership link isn't strong enough.
So specific technical situations can lead to relief. Any others just for category 5?
Yes, there's one called the unrelated constructive U.S. shareholder exception. This can apply if it's a foreign-controlled CFC, you're a U.S. shareholder, but don't own that Section 958A stock, and you're not related to the CFC. Again, very specific, but it shows the IRS is trying to avoid unnecessary filing burdens in certain remote ownership situations.
This is really helpful because it clarifies these aren't loopholes. They're actual intended exceptions written into the rules by the IRS to prevent duplicate reporting or when the U.S. connection is weak. Knowing these exceptions is just as critical as knowing when you do have to file.
Absolutely. Understanding the off-ramps is key to managing the compliance burden effectively. It directly saves time, effort, and protects you from penalties for non-filing if you genuinely qualify for an exception.
Okay, so we know who files and when they might not have to file. Let's get into the real meat of it now. How these foreign interests actually hit your bottom line. Income, deductions, credits. How does this all affect your U.S. taxable income? We have to start with Subpart F income, right?
Yes, Subpart F. It's a term that often causes some anxiety, and for good reason.
Because it's income you can't hide, essentially, even if it's earned overseas by the foreign company.
That's a great way to put it. Subpart F income is income earned by a CFC, that controlled foreign corporation, which becomes taxable immediately to its U.S. shareholders, even if the CFC hasn't actually paid them a dividend.
Wow. Taxable even if you haven't received the cash.
Exactly. It bypasses the usual rule of only taxing distributions. Schedule I on Form 5471 is where you report your share of the Subpart F income. It's the IRS's primary tool to prevent U.S. taxpayers from parking certain types of passive or easily shifted income offshore indefinitely to avoid U.S. tax.
Okay, so it's an anti-deferral rule. What kinds of specific income often fall under Subpart F?
Well, there are several categories, some quite complex. Things like tiered hybrid dividends moving between related CFCs where maybe there's a tax deduction mismatch between countries, or certain amounts related to specific transactions involving prior tax benefits under Section 245A. Schedule I gets into these details.
Sounds complicated. But you mentioned potential tax savings here, too. Are there ways to reduce the amount of Subpart F income that actually gets taxed? This is where listeners can really benefit.
Yes, definitely. And this is crucial. One of the most powerful provisions is the de minimis rule.
Mm.
You find this usually on Worksheet A, which helps calculate Subpart F.
De minimis, meaning small amounts.
Exactly. If the CFC's bad income, basically, its foreign-based company income plus gross insurance income is less than the smaller of two numbers.
Yeah.
5% of its total gross income or $1 million.
Okay, less than 5% or $1 million.
Then none of that income is treated as foreign-based company income or insurance income for Subpart F purposes. You basically get to enter zero for those amounts. And you skip a whole bunch of complicated calculations that follow.
Like, seriously, so if the bad income is small enough, it just goes away for Subpart F purposes, you don't pay tax on it.
Correct. For Subpart F purposes, it's
Yeah.
a huge relief, especially for smaller operations or companies with just incidental amounts of this type of income. It's a direct tax saving and a massive compliance simplification.
That's incredible. That de minimis rule sounds like something everyone needs to know about. What's the flip side? What if the bad income is really high?
That's the full inclusion rule, also on Worksheet A. If that same sum of bad income, foreign-based company income, and gross insurance income is more than 70% of the CFC's total gross income, then the entire gross income of the CFC is generally treated as Subpart F income.
Ouch. So small amounts get a pass, large amounts mean everything gets pulled in. Good to know both ends of the spectrum. What if the foreign company is already paying a high rate of tax in its own country? Isn't it unfair to tax it again as Subpart F?
Absolutely. And the IRS addresses that with another major tax-saving mechanism, the high tax exception.
Okay, how does that work?
If certain types of Subpart F income, like foreign personal holding company income or foreign-based company sales or services income, are subject to a high effective rate of foreign tax, generally more than 90% of the top U.S. corporate rate, then that income can be excluded from Subpart F.
Ah, so if it's already taxed heavily abroad, the U.S. essentially says, okay, that's enough tax, and doesn't hit it again with Subpart F.
That's the idea. It prevents double taxation at high rates and is a very common way U.S. shareholders reduce their Subpart F inclusions, especially for operations in high-tax countries like many in Europe.
That makes perfect sense and sounds like a really important planning tool. Are there any other direct deductions related to these foreign inclusions?
Yes, for corporate U.S. shareholders, there's the Section 245A dividends received deduction. This can allow a corporation to deduct the foreign source portion of dividends received from certain foreign corporations, and it's sometimes applied to Subpart F inclusions related to stock sales by CFCs too. It's part of integrating the U.S. corporate tax system and directly reduces taxable income for qualifying U.S. corporations.
Okay, so specific deductions for corporations. Beyond Subpart F, what about other deductions impacting U.S. tax? You mentioned FDII earlier.
Right. FDII stands for Foreign Derived Intangible Income. If a U.S. corporation claims a deduction under Section 250 for its FDII, which is basically income from exporting goods or services tied to U.S. intangibles, specific amounts related to this deduction get reported on Form 5471, Schedule G. This Section 250 deduction is a direct incentive that lowers U.S. taxable income.
So another potential deduction to be aware of if you have export-related intangible income. Now, let's talk foreign tax credits. This feels like the main way most people avoid double taxation.
It absolutely is. The foreign tax credit, or FTC, is probably the single most important mechanism for mitigating double tax. It allows you to claim a credit against your U.S. tax liability for foreign income taxes you've paid or are deemed to have paid. It's a direct dollar-for-dollar reduction of your U.S. tax bill, which is obviously a major tax saving.
And Form 5471 plays a big role here.
Huge role. Schedules E, E1, and especially Schedule Q are all about tracking and allocating foreign taxes. Schedule E, for instance, tracks deemed paid taxes. Taxes paid by lower-tier foreign subs that get attributed up to you when earnings are included in your income or distributed.
And you mentioned allocation is key. You can't just lump all foreign taxes together.
No, you definitely can't. Schedule Q is famously complex, but it's incredibly important. It forces you to allocate the foreign taxes paid by the CFC to different categories or baskets of income. Subpart F income, tested income, which is most other active business income, residual income, etc.
Why is that allocation so critical?
Because the amount of foreign tax credit you can claim in the U.S. is limited based on the U.S. tax attributable to that specific category of foreign income. So getting the allocation right on Schedule Q is absolutely essential to maximize your allowable foreign tax credits. Mess it up, and you could be leaving valuable credits on the table, effectively paying more U.S. tax than you need to.
Okay, so meticulous allocation on Schedule Q equals maximizing tax savings from FTCs. Got it. Are there any foreign taxes you just can't claim a credit for?
Yes, absolutely. Not all foreign taxes qualify. Taxes paid to sanctioned countries, for instance, or taxes that are related to certain specific disallowed benefits, like under Section 245 AD, or taxes that are suspended under Section 909 due to complex splitting arrangements. These taxes might get reported, but you can't claim a credit for them. It's important to know what's creditable and what's not.
Good point. What about changes to prior year taxes, like getting a foreign tax refund?
That's covered by Section 905C.
Mm-hmm.
Generally, if there's an adjustment to your foreign taxes paid for a prior year, you pay more or get a refund. You usually have to go back and amend your U.S. tax return for that prior year to reflect the change in your foreign tax credit.
Okay, so adjustments can mean going back in time. Let's shift gears slightly to earnings and profits, E&P, and distributions. This sounds fundamental to how the foreign core's money flows and gets taxed.
It is absolutely fundamental. Schedule J is where the CFC's accumulated E&P is tracked, usually in its local currency. And it's broken down into different categories, including, crucially, various subgroups of previously taxed E&P, or PTEP.
Previously taxed, so income that's already been subject to U.S. tax, like Subpart F.
Exactly. And tracking these PTEP subgroups is vital. Why? Because the rules for claiming foreign tax credits when PTEP is eventually distributed can differ depending on the type of PTEP, especially for individual U.S. shareholders because of Section 965G.
Okay, so the history of the earnings matters. How do actual cash distributions from the CFC get treated for U.S. tax? Is there an ordering rule?
Yes, and this ordering rule is critical for tax planning and potentially tax saving. The rule is that distributions are considered to come first out of any available PTEP pools. Only after all the PTEP is distributed does a distribution start tapping into the other accumulated earnings, the Section 959C3 balance, which hasn't been taxed yet in the U.S.
Why is that order so important?
Because distributions of PTEP are generally not taxed again when received by the U.S. shareholder. You already paid U.S. tax on that income when it was earned under Subpart F or Section 9, 5, and 6. So if your CFC has a large PTEP balance, you could potentially receive significant cash distributions from it completely tax-free in the U.S.
Wow. So knowing your PTEP balance is key because it represents a pool of money you can potentially pull out of the foreign company without triggering more U.S. tax. That's a huge tax saving right there.
It's a massive planning point. Understanding and tracking your PTEP is absolutely essential for managing your U.S. tax on foreign operations effectively.
What about currency fluctuations when PTEP is distributed, if the exchange rate changed?
Yes, that adds another layer. Distributions of PTEP can trigger foreign currency gains or losses under Section 986C, based on the change in exchange rates between when the income was included and when it's distributed. This gain or loss is reported on Schedule I and impacts your U.S. taxable income.
Okay, something else to watch. You mentioned hybrid deduction accounts earlier, too. Can you briefly explain those again? They sounded complicated.
They are complex, yes. They're an anti-abuse rule under Section 245A. Basically, they track situations where a CFC gets a deduction under foreign law for a payment, like interest on a hybrid instrument, that's treated as a non-deductible dividend for U.S. tax purposes. These accounts ensure that the corresponding dividend income received by another CFC doesn't improperly benefit from certain U.S. tax rules, like the Section 245A DRD, and might even be treated as Subpart F income. It's about preventing double non-taxation through these hybrid mismatches.
Got it. Anti-abuse focused. What about Section 956, investments in U.S. property by the CFC?
Right. Section 956 can trigger a U.S. tax inclusion if the CFC invests its earnings in certain U.S. property, like loans to U.S. shareholders or U.S. real estate. It's another anti-deferral rule. But, and here's another potential tax mitigation point, the amount included under Section 956 can be reduced by the CFC's P2P balances.
So P2P can shield against Section 956 inclusions, too.
Exactly. Earnings that have already been taxed in the U.S., PTEP, can effectively absorb or offset a current year, Section 956 inclusion. Is another reason why tracking PTEP is so incredibly important for minimizing U.S. tax.
P2P seems like the unsung hero here for tax efficiency. Okay, quickly, what about cost-sharing arrangements and related party transactions, Schedules G1 and M?
Right. Schedule G1 is for CSAs, often used for developing intangibles. Reporting costs and benefits correctly here is crucial for transfer pricing compliance, which directly impacts how much income is allocated to the U.S. versus the foreign participant. Getting this wrong can lead to big IRS adjustments. Schedule N tracks transactions between the CFC and related parties, loans, sales, etc. While not a direct tax saver, accurate reporting here is vital for transparency and avoiding IRS scrutiny or audits related to transfer pricing or earnings stripping. It's about demonstrating compliance.
Okay, good preventative measures. Let's step back from the detailed calculations and touch on some other important nuances. You mentioned Form 8833 and treaty positions earlier, worth a quick reminder.
Definitely. If you're using a tax treaty to reduce your U.S. tax, you generally must disclose that on Form 8833. It's a legitimate way to lower tax, but the disclosure is mandatory. Fail to file it, and you face those penalties, $1,000 for individuals, $10,000 for C-Corp. So take the treaty benefit, but file the form.
Use the treaty, file the form, simple enough. What about practical stuff like computer forms, ID numbers, addresses?
The IRS is picky. Computer-generated 55471s need to look exactly like the official ones unless you get prior approval. Identification is key. SSN for individuals, EIN for entities. Use full foreign country names, not abbreviations, and proper postal codes. Financials are generally in U.S. dollars, using consistent exchange rates, unless special rules like DAS-DIM apply.
Meticulous detail matters, and those business activity codes.
Yeah, the NAICS codes. You have to pick the code that best describes the CFC's main business. It just gives the IRS context about what the foreign company actually does.
Okay. Lastly, a big emerging topic, those Glober rules, or Pillar 2, how do they fit in?
This is a huge global development. The OECD's Pillar 2 rules aim for a 15% minimum effective tax rate globally for large multinational groups. Some countries are already implementing related rules like QDMTTs or IRRs.
So this isn't really about U.S. tax savings, then?
No, quite the opposite usually. It's designed to increase tax on low-taxed foreign income to meet that 15% minimum. Well, the 5E471 instructions just mention it now. It's critical awareness for anyone with significant foreign operations. These global minimum tax rules are reshaping the international tax landscape and will need to be factored into future planning, potentially impacting the CFC's overall tax burden and, indirectly, the U.S. shareholder.
Definitely something major to watch. Okay, so wrapping up this deep dive, we've really journeyed through the maze of Form 54701, who files the different categories, the complex schedules for income, EMP, taxes.
And crucially, we highlighted those vital exceptions, like constructive ownership, that can provide genuine relief. We also pinpointed those powerful tax-saving or mitigation rules, the de minimis rule, the high tax exception for Subpart F, the massive benefit of tracking and using PTEP to receive tax-free distributions or shield Section 956 inclusions, and maximizing foreign tax credits through proper allocation. These are the tools within the complexity.
I think the biggest takeaway here isn't just the rules themselves, but realizing how easily international tax can touch you, even through things like inheritance or indirect ownership. Being aware isn't just defense against penalties, it's actually your best tool for finding opportunities to optimize your tax situation. This deep dive hopefully gives you that starting point to be informed, strategic, and maybe even find some unexpected tax efficiency hidden within Form 5471. The question is, now that you know where to look, what will you find?